So, as we just finished, you should realize now that after looking at several different transactions, if we analyze it correctly, it will show us the framework of how we account for stuff in financial accounting. And basically, we just went through several different transactions and we saw how each particular transaction affected series of accounts that belong in particular categories. At this level, you should be focusing on one of the following things. You should be focusing on how accounts are being categorized. What are assets? What are not assets? What are liabilities? What are not liabilities? It's simply what makes up stockholders' equity. And then as you read those transactions, you should be identifying what are the key words, because the keywords are going to bring you to the actual account itself and how it's being affected. So we finished doing all the particular transactions, and I just did a quick summation of the totals and the changes of the particular groups. So we see that our assets, if we added up all of our asset accounts that were affected in the value, the total value would be $31,700. Now, if we looked at our liabilities and added up all the liability accounts, how they were affected, we see that we have $200. If we did the same exact thing for our stockholders' equity, you should realize that we have $31,500. And what I wanted to point out is that at the end of the day, our total assets still equaled our total liabilities plus stockholders' equity. That is always the objective. And so you should make sure that you spend a lot of time working homework assignments and getting a good fundamental understanding of transaction analysis, because that's where it starts. You will not be able to do anything in accounting unless you understand this right now. I also want to take a point out to say that everything accumulates, and what you guys are learning now will follow you through the rest of your accounting career. Okay? The next thing that I want to talk about are the reporting side of accounting. Remember, we said accounting was a process that does two particular things: records and reports information. So basically, the first step is the recording part. You record all the information by analyzing those transactions, similar to what we've just done, and you do that every day. Towards the end of a period, it could be the end of a month, it could be the end of a year, it could be the end of a quarter, it doesn't matter. Towards the end of a period, you're going to take all that information that you've recorded by analyzing transactions, and you're going to summarize that information into reports. Those reports, we call them to be financial statements. So as of right now, you have 4 financial statements that you need to be aware of. Financial statements are simply those reports that we talk about. These financial statements would normally be reported in a particular order. Your first financial statement, your income statement, your next financial statement would be your statement for retained earnings. Your next financial statement will be your balance sheet. And your next financial statement will be your cash flow statement. These are your 4 financial statements in that particular order. So let's go and start talking about these. Your first statement is an income statement. Again, guys, I'm always considering that you need to be aware of the keywords. In accounting, we're going to give you a lot of keywords, and those keywords are going to logically help you solve your problems. Okay? Income statement. What's the definition of an income statement? Well, I like to keep stuff simple. An income statement is a statement that reports income for a period. That's all it does. It's a statement that reports income for a period. So what are the keywords out of that definition? It reports income. What's income? How do we measure income in accounting? We already talked about that, right? We measure income by taking our revenues and subtracting our what? Expenses. So, your income statement is only going to have those particular accounts on there. Your income statement is going to have your revenues minus your expenses. That's the statement that shows you how to calculate your income for a period. It's going to take your revenues and it's going to subtract your expenses. Okay? Those are the only accounts that should show up on the income statement. Your revenues and your expenses. Nothing else should belong on your income statement. Only those accounts should show up on your income statement. Okay? Now, your next statement would be your statement of retained earnings. And what's your definition of your statement of retained earnings? Your statement of retained earnings is simply a statement that shows the changes or the effects of retained earnings for a period. Shows the changes or the effects of retained earnings for the period. Okay? So remember when we started talking about retained earnings. Go back to your notes. Hopefully you're taking notes. Remember when we started talking about retained earnings, we said retained earnings, one word definition was what? Income. Right? And how do we measure retained earnings? We measure retained earnings by taking our revenues minus our expenses. So our income statement is going to give us our income. But we also know that there are things that affect income for the period. Okay? What things affect income for the period? Well, or retained earnings for the period, should I say. What things affect retained earnings? 3 things. Net income, net loss, or what? Dividends. Net income, net loss, or dividends. Okay? So for our statement for retained earnings, will only have our beginning balance of retained earnings, and we will add or subtract net income / loss. Now, how will we know if we're going to have a net income or a loss for the period? How will we know? Where are we going to get it from? The income statement. That's why the income statement is first. So our income statement is going to take our revenues and our expenses for a period. We're going to report them, and we're going to subtract them to get our income. Once we get our income for the period, we know that that will affect our retained earnings. If we have an income, we're going to add it to our beginning balance. But if we have a loss, what should we do to this retained earnings? Subtract it. And so the only other component of your statement for retained earnings will be that you have to subtract what? What else affects retained earnings? Dividends. Dividends. So that will only be considered a part of your statement of retained earnings. Your beginning balance, you're going to add or subtract your net income or loss depending on what you could calculate it in your income statement. And you have to not forget to subtract your what? Dividends. That's all it is. That's going to give you your ending balance of retained earnings. Okay? Your balance sheet. What is your balance sheet? What is your balance sheet? Your balance sheet is simply your accounting equation. Your balance sheet is simply your accounting equation. So what's our accounting equation, folks? Assets equals liabilities plus stockholders' equity, right? So basically what our balance sheet does is our balance sheet summarizes our ending balances for the accounts that pertain to the accounting equation. So our balance sheet is going to show our ending balances of certain accounts at a particular point in time. Now, something I want you guys to realize is that the income statement and the statement of retained earnings represent periods. The balance sheet represents a point in time. Think of it like a picture. When you take a picture of me doing this, all that picture could tell you right then and there is what I'm doing at that point in time. Can't tell you what I've done before or after. Same rule applies with the balance sheet. The balance sheet only represents that point in time in which the report was generated. Why? Because balances do what as time goes? Change. So what accounts belong on the balance sheet? Assets, liabilities, and what? Stockholders' equity. Assets, liabilities, and stockholders' equity. And at the end of the day, our assets and our liabilities for stockholders' equity should do what? Balance. Should do what? Balance. Okay? Now, this ending balance from retained earnings that you're going to calculate from your statement of retained earnings, let's talk about that. Our stockholders' equity is broken down into two parts, right? The two parts of our stockholders' equity is paid in capital, which is really issuing what? Common stock. And our other part of stockholders' equity is what? Retained earnings. We're going to get our retained earnings amount from our previous statement. Do you guys see the connection? Do you all see the connection? So our income statement starts off with our revenues minus expenses. That's how we get our income. We take that income figure to show the effect of our statement of retained earnings. And once we calculate our ending balance of retained earnings, we have to put it in our balance sheet to calculate our new earnings balance. So all of this stuff connects. And that's the framework of accounting. And so in order for you to get the balance sheet correct, you first have to get the what? Income statement correct. Then once you get the income statement correct, you need to get the what? Statement of retained earnings correct. Once you get the statement of retained earnings correct, then you can finish out the balance sheet.